afternoon, and thank you for joining. Dual ledger mastery, manage both sides of your lease portfolio without building two systems. My name is Jacob Abrams, and I'm a solutions engineer here at the Lease division of Insight Software. And now to our speakers. I'd like to first introduce my colleague, Nikhil Gupta. Nikhil is a chartered accountant working as a senior consultant at Lease Accelerator, an Insight Software company, specializing in helping companies navigate the complexities of lease accounting compliance. He has supported numerous clients in implementing solutions for ASC 842 and IFRS 16 and streamlining their whole lease accounting processes. So over to Nikhil now.
Thanks, Jacob. Let me introduce Jacob. Jacob is a solutions engineer for Lease Accelerator. Over the years, Jacob has worked in business development, having conversations with clients around lease accounting, external and internal audit, as well as reporting. He joined Lease Accelerator at the beginning of 2020, so just between the waves of public and private companies trying to adopt the new lease accounting standards. Since then, Jacob has worked with many organizations to get compliant, as well as maintaining and going beyond that compliance to now focusing on optimizing their end-to-end lease lifecycle process.
Awesome. Thanks, Nikhil. So now to our agenda, a brief summary of our agenda. We'll start by going over why companies are managing both sides being the lessee and lessor side of leasing. Next, we'll highlight how it's currently being managed, silos, spreadsheets, and separate systems. Then we'll cover the key differences between lessee and lessor accounting, so you know. We'll talk about a unified dual ledger management approach we recommend that will consolidate the data and save a lot of manual time. And then next, we'll look at an actual case study with real lessons learned, and then finish off with closing remarks. So I'll lead us through the content. We'll dive into the first slide here, first talking about leases in general and help you identify first if you have a lease. It's not always obvious that a contract contains a lease. For example, if I'm providing data center space to a customer, is there a specific server I'm leasing, or do I simply have a service contract for some amount of computer capacity? Or do I have an embedded lease in a contract that also provides services? So these are questions you'll need to ask yourself. To figure this out, let's look at how ASC 842 defines a lease, which is as a contract or part of a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So that's the definition. Let's break that down into two key components. The first requirement is that the contract must involve an identified asset. This means that the asset must be explicitly or implicitly specified in the contract. You might look for a specific serial number as evidence of this versus something like consumable equipment. Next, the asset must be physically distinct, or the customer has rights to substantially all of the asset's capacity. So if the asset is a portion of a larger asset, the customer must have rights to substantially all of the capacity of that portion of the asset. So that's an important kind of differentiator there. Next, the supplier does not have a substantive substitution right. So if the supplier, in this case, that's you as the lessor, can substitute the asset at will, and if the supplier would benefit economically from the substitution, then the contract likely does not contain a lease. What you're providing is a service, and the specified asset used to provide that service is at your discretion then. Once you've identified an asset, then you need to consider if the contract gives the lessee control of the asset. Ask, does the customer have the right to obtain substantially all economic benefits from the use of the asset? And does the customer have the right to direct the use of the asset? So let's say you sign a contract for a pipeline. If the lessee is obtaining substantially all economic benefits from the use of that asset, even if there is some capacity used for other purposes, you likely have a lease. Generally, you can look at the location of an asset to determine control. If the asset is on the lessee's premises, it's likely controlled by them. So now, naturally with a webinar like this, we get attendees that are at different stages of their journey towards subscription services. So I always like to start with some baseline terminology and recommendations based on what we've seen working with our customers. Starting with software as a service, SaaS, instead of paying a one-time fee for software and just owning that version like a Microsoft Word, you pay for it on a regular term, like annually, and you always have the newest version as long as you're paying for it. Next, the definition of EaaS, equipment as a service. It takes the same concept and applies it to physical equipment. So customers don't buy the physical asset, they pay for usage or outcomes like hours of operations or units produced. There are a host of different revenue models in this space. For example, maybe you don't even monitor usage. They get the asset and have full control over it, and you just include maintenance, updates, and upgrades. So we've seen examples of that. Or you can go to the other end of the spectrum and only charge when the customer gets some sort of business outcome. Lower upfront costs for customers, and for providers, it means long-term contracts and ongoing revenue instead of one big sale. You might see device as a service mentioned, especially if they're a computer manufacturer or just product as a service. It's all in the same kind of sphere. And in some cases, it's just mentioned as XaaS or everything as a service. Ultimately, what we're talking about here is servitization. Servitization is the broader strategy behind all of this. It's the shift from selling products to delivering services around those products. On this journey, you'll always want to set up different financial metrics to track success. So that leads us to the middle column here of the slide. So ARR, annual recurring revenue, it's one of the most critical metrics in a subscription model. It's the amount of revenue you earn per year on a contract. So if a customer pays $1,000 per month, then that's a $12,000 ARR. Once you know your ARR, the next question is you'll have to ask yourself is, how much of it will I naturally churn as certain contracts expire and customers leave? That would be called GRR, gross revenue retention, measures how much recurring revenue you keep from existing customers over time without counting upgrades. So the goal here is to keep that number very high because retention is the foundation of recurring revenue growth. Varies by industry. You might also want to track the number of total customers. So customer lifetime value, or LTV, tells us how much total revenue a customer will bring in over the entire relationship. So another key metric to look out for. Finally, the main reason we're here today is to pull back the covers on how lease accounting plays into this world. What companies often don't realize is that their subscription service is actually in part a leasing service. You might not call it a lease, and I've seen contracts that say, this is not a lease, but it was. And we'll help you answer those questions on if it was a lease, and then throughout, talk about how you can optimize your subscription service, especially with the leasing portion of it.